If we buy a property that's run really, really poorly, expenses are all over the place, and we run the property more efficiently, reduce expenses, increase NOI, we increase the value of the property ourselves. That's within our control. Yes. Are there other factors? Yes, we'll talk about that. This is a quasi oversimplification, but I want you to see the bigger picture of commercial real estate has more control, which is why we're in it, because we can't force appreciation as strongly in the single family home space as we can in commercial real estate. We can also buy a property where rents are extremely low and below market. And we can raise rents even further, but still keep them below market to draw in residents. And all of a sudden, net operating income is up because we increased revenue for where we bought it, and the valuation of the property is higher. We're forcing appreciation.
Welcome to the Secrets to Abundant Living podcast. Your guide on this journey is Amy Sylvis, ready to unlock the keys to a life of true abundance. We're diving into everything from financial freedom and optimal health to meaningful relationships, geographic freedom, and everything in between. It's about creating a life rich in experiences, purpose, and joy. Get ready for empowering conversations, expert insights, and real-life stories that inspire you to live abundantly. If you're ready for the secrets to an abundant life, hit that subscribe button now, and let's get started.
Secrets to Abundant Living podcast community. Welcome to another episode of the podcast. For those who don't know me, I am Amy Sylvis. I'm the founder and CEO of Sylvis Capital. We connect investors to hands-off real estate investment opportunities that produce passive income. And our podcast exists to help you create more abundance in your life. So if you're new, welcome. If you're returning, gosh, we're so glad to welcome you back. We've got an exciting episode today. So our framework, as you all know, is these solo episodes. We typically talk about financial abundance. It is this vehicle that creates or helps us get to the destination of more freedom of time, of association, of contribution, of location. So our destination isn't financial freedom. Our vehicle is hands-off income and financial freedom to get us to live life on our terms. And today's episode, I've got 2 myths I want to bust for you all today because I actually heard these last week. And I thought, you know what? I think this would make a really informative and helpful podcast episode and resource for folks who are interested in getting to know the commercial real estate space. So commercial real estate isn't for everybody, but for us at Sylvis Capital, we like it because it provides such great economies of scale and allows us to mitigate risk and invest in really exciting markets throughout the United States. I live in LA. I sure do not invest in LA. We invest in the Southeast and the Midwest. And of course, actually, 2 weeks ago, we closed on a 402 unit apartment building in the DFW, the Dallas-Fort Worth area with our investors. So very excited to celebrate that. Beautiful deal. If you haven't been following me on LinkedIn, you can go there and see pictures that we took on a trip to DFW just a couple of weeks ago for that close. But we believe that you all being informed, educated, and of course, understanding and being able to spot myths really allows you to be the best investors you can be in this space. Because look, you understand your risk tolerance best. You understand your goals the best. You understand your time horizon best. That's not our job. You understand that. You bring that to the table. So if we give you information, you can evaluate opportunities and really decide what fits for you. So what are the 2 myths that we're going to dispel today? The first one is, hey, housing prices are not going to go up. It's not a good time to invest. Housing prices aren't going to go up, so let's not invest right now. Hey, maybe you believe that. Totally fine if you do. I'm going to provide you some data because we're data-driven investors and some frameworks to help you understand how we think through information like that. And then the second one is interest rates are high because they are relatively high compared to the past 10, 15 years or so. So if interest rates are high, we shouldn't be investing right now, right? It's a really bad time to invest in real estate. If you're not watching on YouTube, I think we also have video on Spotify. You may want to hop on those because I'm actually going to be doing some visualization. Well, I'm not going to walk you through a visualization. That sounds like we're meditating, but I will have visuals with data and numbers to show you some of this information. Again, look, this is not a podcast that is also an audio book of a 300-page book giving you every single nuance and every single piece of information to evaluate a deal, right? This is a top level myth busting episode that's probably going to be around 10 or 15 minutes long to arm you with high level framework to think through these larger questions. It is not going to include every single nuance you should check out. We'll give you some resources at the end of the podcast episode for you to take a look at. But just please know, sometimes I get people saying, wait a minute, you didn't talk about this. Wait a minute, you didn't talk about that. Yes, this is not a 3-hour lecture on how to buy real estate. I am not telling you how to buy real estate. I'm simply giving you data, giving you facts and education, not recommendations on these two myths so that you have a more empowered understanding. So hopefully we're all on the same page there. I hate that I have to make that disclosure, but look, it's an educational podcast, but it's not meant to be the only education that you get to evaluate a real estate opportunity. Okay, so let's tackle the first myth, which is, hey, housing prices aren't going to go up. It's 2025, it's June, and maybe I heard something on the news or the lay press or something. Housing prices aren't going to go up. Let's not invest. Okay. First thing I want to challenge you all with is, what does housing mean? Because I think many of us are familiar with and may default to single family housing. And the truth is, single family housing and prices going up or values going up in single family has very little relationship to commercial real estate. So I think a lot of people cut and paste their experience in single family housing to commercial real estate. And hey, if you're a single family housing investor, that is not what I'm talking about here on this podcast. I've never purchased a home myself. I don't invest in single family homes. There's a whole other episode of why I decided to invest in commercial real estate, and our investors decided to invest alongside of us in commercial real estate. But the bottom line is, I want to make sure you understand that commercial real estate's not the same in terms of valuation for single family homes. So our single family home value is not going to go up. Maybe, hey, interest rates are high. That is a big factor in single family housing investment. But listen, there is no one United States real estate market. I'm in LA. I own in Dallas. I own in Evansville, Indiana. I own in Huntsville, Alabama. I own in Kansas City, Kansas. None of those markets have the same inputs and factors in terms of valuation. So this whole notion that entire geography, an entire massive block of land called the United States is going to move in a single direction in single family housing, in this lady's humble opinion, is a bit lacking nuance. So we're not talking about single family housing. We're also not talking about the United States real estate market. What we are talking about is commercial real estate. And we're obviously going to look at market specific factors in terms of what influences valuation. And here's the bottom line. Very often, single family home valuations are based on one, interest rates, right? Because folks buy based on the monthly payment they can afford and of course the down payment, but also value comps in the area, right? There's not a whole lot. There is some, but there's really not a whole lot that can be done in the single family house to force appreciation. The commercial real estate space, I'm going to say this loud for the people in the back, commercial real estate space, valuation is based on net operating income. It is a business. So one more time, valuation for commercial real estate is based on net operating income. What is NOI? What is net operating income? That is your revenue minus your expenses. Yes, if you own a single family home, do you have revenue and expenses, especially if you rent it out? Sure, but that's not how the property is valued, right? In the commercial real estate space, it is. So you probably see where I'm going. This gives us levers to pull. if I buy an apartment complex, like I just bought a 402 unit, it comes with revenue and it comes with expenses, and those work together to create NOI, net operating income. So if the property, and I'm going to show you some hard numbers, right? So I'm giving you the overview right now, and then we can talk about the actual tangible numbers. So if I want to increase the valuation of a property, aka how much I can sell the property for, here's the scoop. I can increase the revenue, right? I can increase rents. I can increase other pieces of revenue like laundry or trash or right? I can also decrease expenses, improve the way the property is run, reduce expenses. Both of those levers are within my control to increase net operating income. And when we increase net operating income, either by increasing revenue or decreasing expenses, we increase NOI, we increase the valuation, and that's called forced appreciation. We actually have control because it's a business in the commercial real estate space to force that appreciation. So, does that mean that housing prices aren't going to go up or housing isn't going to go up? Students, we shouldn't invest? No. Because guess what? If we buy a property that's run really, really poorly, expenses are all over the place, and we run the property more efficiently, reduce expenses, increase NOI, we increase the value of the property ourselves. That's within our control. Yes. Are there other factors? Yes, we'll talk about that. This is a quasi oversimplification, but I want you to see the bigger picture of commercial real estate has more control, which is why we're in it, because we can't force appreciation as strongly in the single family home space as we can in commercial real estate. We can also buy a property where rents are extremely low and below market, and we can raise rents even further, but still keep them below market to draw in residents. And all of a sudden, net operating income is up because we increased revenue from where we bought it, and the valuation of the property is higher. We're forcing appreciation. This is the whole game, y'all. So I really think it's short-sighted to say, oh my gosh, we shouldn't invest in real estate right now because housing prices aren't going to go up. No, we can force appreciation. So I'm going to show you some numbers. We're going to take a quick iced green tea, Starbucks sip break. Anyone else drinking coffee or tea? Okay, we gotta stay caffeinated there. That's one of my favorite drinks. No sugar, just purely caffeine. Okay, so let's share our screen here. Hopefully, yeah, I think you all are seeing this. Let's hide this for right now. Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to sylviscapital.com/webinar. Again, that special link to reserve your seat for free is sylviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show. So here is something I want to introduce you all to, and it is this concept of net operating income, right? That's the revenue minus expenses. And if we divide that by the purchase price or the valuation of the property, that gives us the cap rate. The cap rate. So I'll talk to you about what the cap rate is, but let me just give you this example here. Let's say the NOI for a property, these are just totally made up numbers for simplification, is $500,000. We divide that NOI, that's on an annualized basis, by, let's say the purchase price is $10 million. That gives us a cap rate of 5%. Why does that matter? Amy, what does a cap rate mean? So the cap rate is the expected rate of return on an investment property based on its NOI relative to its current market value or purchase price. So essentially, the higher the cap rate means that there's a higher potential return, but it may also come with higher risk. A lower cap rate means or could mean that there's a little bit of a lower return, but there might be a more stable, low risk investment. So, why am I introducing you to this concept called a cap rate? This is something that we use in commercial real estate because what we can do is understand that there's generally a going cap rate for a certain type of commercial real estate property in a given market. Let's just say, again, these are hypothetical. I'm not saying this is accurate yet right now. Let's say in the Huntsville, Alabama market, because I know we used that for market research analysis a few episodes ago. Let's just say that the going cap rate in an area is 6%. Let's just say. So we can actually figure out property valuation if we understand and we can know that, let's say, a Class B property in Huntsville, Alabama typically trades at a 6% cap rate. And we also know the NOI, the net operating income of the property, because every commercial real estate property has an NOI. We know that, we get that from the seller. We can determine the valuation of the property. Hang in there with me because I know this is technical, but I'm painting a picture here for you to understand and be educated. So when you choose to invest, or if you've already invested, you can track these things. So we're going to turn this formula on its head and actually say, like I mentioned, if we're looking at a property and we understand that the net operating income of a property, we know what that is. We divide it by a cap rate. Again, we can find out what the cap rate is for a given property, a given asset in an area. So that's pervasive throughout the market. So we have those two fixed inputs, the NOI, the cap rate. We divide those. That will give us the purchase price of the property or the valuation of the property. So let's just say in this hypothetical example, again, this NOI was $500,000. Let's say we're buying this property in Huntsville. Great. $500,000 property, or excuse me, $500,000 NOI. We get that from the seller. That's on the day we close. And we know that it's a Class B property. Let's just throw that out there. And let's say for Class B properties in Huntsville, Alabama, the cap rate is 6%. Well, that means we're going to pay a little over $8 million for the property, $8.33 million. So again, I'm going to throw out this disclaimer because I hear a few people chirping in the background. This is not a graduate studies course in commercial real estate valuation. No one wants to listen to a podcast that goes in depth. I am giving you a general overview, a high-level overview, rules of thumb, so that you are equipped to do a quick understanding of what's going on in the commercial real estate space in terms of valuation and strategy. Okay. So we were given the NOI, we were given the cap rate, and we plugged that into the formula and we ended up purchasing this property for $8.33 million. Now let's say this property was very poorly run. It's one of the reasons we bought it. Property management was out of control. Expenses were way out of control. They were spending all this money on insurance. They were spending all this money on repairs and maintenance. Just really sloppy. Maybe the owner was actually running some of his own personal expenses through the property. You'd be shocked. And so there's all these marketing expenses that are really high. And we go, wait a minute. We don't need to spend all that on expenses. We're experienced commercial real estate operators. We can lower those expenses by $100,000 a year easily and still maintain the same revenue, still give our residents a great experience, a great living experience. Can absolutely do that. So by reducing expenses by $100K, we actually increase the valuation, increase the NOI, the net operating income, from $500,000 to $600,000. Not bad. Increased by $100K a year. What does that do to the valuation of the property? This is so cool, y'all. If you've heard this before, great. Get excited. Let me know in the comments. But by increasing for this particular property, the NOI by $100,000, and the market is still at a 6% cap rate, the new valuation of the property is $10 million. That is an increase of $1.67 million in terms of valuation and where we could sell the property just by increasing NOI by $100,000. Are you seeing the power of this? $100,000 translates in NOI annually translates to a $1.67 million increase in property valuation. So in theory, yes, there are other factors, but I want you to get the overall general concept. We could turn around a property, lower expenses by $100K and make $1.67 million on an $8.33 million property just by running it better. Do not tell me that housing prices aren't going to go up and now is not a good time to buy. Are there other factors? Sure. Are there other things that we look at? Absolutely. And will I give you more education on those other things in the future? Yes. But I want to arm you with information of this single family home mindset. Nothing wrong with it. But some of y'all are making very important decisions about investing off of information that may not be accurate or that may not be fully educated, if that makes sense. Now, if you're still saying, or you say to yourself, Amy, I still don't want to invest, of course, my goal isn't to get you to invest. It never has been. My goal is education. Someone educated me. I built an amazing life of hands-off income based on that education. But this space isn't for everybody. I just want to make sure that the decision where you arrive in terms of investing is based on accurate and complete information. And this is a deposit in that piggy bank of accurate and correct information. So I'm really curious if in the chat, if you guys will let me know what you think of this example. Your feedback is so helpful. If you've ever done a podcast or a webinar where you're just talking to yourself, sipping your Starbucks, wondering, hey, I wonder if this is resonating with my audience, your comments really, really mean a lot because it's an interesting concept to understand forced appreciation, understand NOI and the value of running a property better that just simply doesn't exist when the average homeowner is just buying a house for themselves. Okay. The other thing, so that's the first myth. I busted it. Whether or not you want to invest in commercial real estate right now, up to you. I'm not telling you what to do. But if you hear, or if you've been thinking, hey, I heard somewhere that housing prices aren't going to go up, so it's not a good time to invest. Hey, it may not be a good time for you to invest based on a whole host of reasons, but I want you to have a look under the hood of how valuations are determined and how we can really have a lot of power over the money that we make in the commercial real estate space. It is so cool. I think we're already 20 minutes in, but I've got one more myth I want to bust with you all. Something else that I've heard, which is interest rates are high. We shouldn't invest. Should not invest in real estate right now if interest rates are high. Hey, let's talk again. Are we talking about single family homes? Or are we talking about commercial? Single family homes, I get that. If you're going off of monthly payment, yeah, higher interest rates are going to make it more difficult for folks to buy the same property, right, at the same purchase price, because it's actually going to be more expensive because interest rates are higher. In the commercial real estate space, y'all, it's a different story because we're buying a business. We're not buying based on comps or appreciation in the area. It can be a wonderful thing to have high interest rates because we may be buying at a lower price. There just are so many differences between single family homes and commercial real estate that I want you to really wrap your head around. Interest rates in the commercial real estate space are not the sole determination of valuation, as I just showed you, right? It's net operating income. It is, yes, interest rates and the type of debt you can get can definitely influence valuations. But again, we're not talking about individual families being able to afford to buy a house. We're talking about businesses buying a business and the cash flow that is associated with that business. And that is a completely different ballgame than single family real estate. So some would argue, and there is some data, there is some contradicting data as well, that valuations of commercial real estate go down, all things equal, when interest rates go higher. Obviously, as I showed you all, if you're buying a property that's poorly run and you increase NOI, even if interest rates go up, you can still likely force appreciation and increase valuation of the property. So a lot of moving parts here, which is why I'm trying to simplify things so you all can extract and understand the overall game. But look, let's just go with the thesis that interest rates make the valuation of properties go down. of commercial real estate going down. I hesitate to even go there because it's so not always that straightforward. Many people believe we're at or near the top of interest rates in the United States, mainly because, hey, we've got about $37 trillion of national debt, about a third of which needs to be refinanced in the next month or two. And the only way to get rid of this national debt is to inflate it away. And that's likely going to come with lower interest rates. Big assumption, not saying that's necessarily true. But wouldn't you think if interest rates were high or near their high, that would be a good time to buy if lower interest rates increase property value of commercial real estate? Wouldn't you think you'd be in a buy low now and sell high scenario once rates are cut? I know the Fed, I think, came out today as I record this saying that the rates are going to be unchanged. But hey, also, jobs numbers didn't look so fancy either. So I love this meme. Again, if you're not watching on Spotify or YouTube, this is my cheeky meme. But I do really wonder when people say, hey, interest rates are too high, if they're not putting on their single family home thought process and completely missing how commercial real estate is valued. And so they're saying, hey, let's wait. And until interest rates are cut, valuations go up. You want to buy at a higher? Huh? I don't know. I think it's funny. You guys know I'm a little silly and sassy, but I really hope that this has served as good education around how valuations are determined, because I don't think many folks have looked under the hood to really understand how this all works and just think housing is housing. I've bought a house before. Higher interest rates is bad for single family housing. So gosh, that must be true for commercial real estate. Could not be further from the truth. If you want to take a massive deep dive, and some of you all do, into commercial real estate investing, this is called The Hands-Off Investor by Brian Burke. Don't look at my nails. I haven't had a chance to do them lately. Don't judge me. Amazing book, fantastic book, especially if you want to be a passive investor and you want to dive deep. It's a really powerful resource. I'll make sure my team puts the link in the comments for you all. But yeah, let me know what you thought of this episode. I really feel the calling to create more educational content for you all, to walk you through how we as successful commercial real estate investors make these decisions, the tips and tricks and strategies we use. So this was a really fun one to record. I know it got a little granular, but please, truly, let me know in the comments. Take a moment on Spotify or YouTube or Apple Podcasts and let me know if you have any questions, if this made sense, if you feel like you understand these myths a bit more. And I'll just leave you with, hey, education is power. I know you're busy. I know there's a lot going on, but this space has been made to seem more complex or something that you can't understand on your own unnecessarily. If I can do it, you can do it. Let's go on this journey together. And again, this is just meant to be education. I am not telling you to invest in commercial real estate. I'm not saying that that's where you should park your funds, but the best way to make that decision is to be armed and dangerous. And this is a great place to get started, especially with myth busting. It is the summer, y'all. It's June. If you're traveling, if you're spending time with family, if your kids are out of school, have an amazing time. I am so grateful, truly, from the bottom of my heart, for all of you who've listened and supported the podcast. This is such a joy. It takes a ton of work and a lot of discipline, but I enjoy it. And your feedback truly means the world. So have a great week. I look forward to seeing you in next week's episode, and we'll talk to y'all soon. Bye for now.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Sylvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.